Good evening and welcome to the Power of Passive Investing. We are thrilled to have our September guest with us, Richard Fowler. Summer went by fast and I can't believe that fall is around the corner. And with fall, with new season, we get new opportunities. So this new opportunity to have new and exciting guests today. But before we get into that, let me just first share my screen and go over our group's details as always. So again, welcome to the Power of Passive Investing meetup. Matt, my co-host, unfortunately couldn't join us tonight, but I'm pretty sure he's going to be viewing the recording once we share it with everyone tonight. The usual disclaimer from my attorney: we are simply doing this for informational and educational purposes only. We're not selling any securities, not offering anything to you. Please always consult your attorney or other professional if you look into buy or sell or invest into anything. Our structure is pretty simple. We bring presenters that provide value to our community. Today's interview is actually going to be in the interview format. So I'll be asking Rich a bunch of questions, and then folks that are live in the audience with us, feel free to post your questions and I'll ask them on your behalf. Or if you want to raise your hand, I'll unmute you and you can ask your question as well. We always post replays on our YouTube channel. I encourage you to sign up, as in addition to these interviews, we post other exciting interviews that we do offline with other interesting entrepreneurs and investors. As mentioned, Rich Fowler has been in real estate for about a decade at this point. He has a very interesting way to invest in real estate, and he'll share with us why we should avoid creative cash flow investments, and he'll go over these points that you see displayed in front of you, in addition to some other points that we'll cover in our Q&A session today. And like I said, feel free to post your additional questions or ask Rich directly, as we always encourage questions. And at the end, we'll share Rich contact information for anyone interested in reaching out and speaking with him further. And as well, Matt, as well as myself, are always available for any of you folks. If you have any questions, interested in investing in real estate or starting your investing journey, feel free to reach out to either one of us or both of us, and we'll be happy to have a conversation with you. So without further ado, Rich, welcome to our group. We're excited to have you. Why don't we start with you sharing with our audience a little bit about yourself and how you got into real estate and what is it that you're doing now in real estate?
Sure. Thank you, Alina, for the invitation. I appreciate that. It's always nice to speak with you. Really quick story. I guess it's not really quick, but I started in industrial. I was in an industry. Thought I was going to work my way up through that, get the degrees, get the bigger positions, and work hard, dedicate yourself to that job. And in 2011, November, they tapped me on the shoulder on Thursday and said that you no longer work for the Timken company, you work for the University of Akron. Fast forward to today, that's really what motivated me to get into real estate. Because what happened at that time, I was about 15 years into a 30-year pension. So what I don't think they thought it was a great thing for me. It was a good opportunity, but here I am starting all over. So at that point, I decided I was going to take care of myself and wasn't going to rely on somebody or a job to take care of my pension or retirement. So I got into real estate. So long story, like I said, did flips, did, single family for quite a while, and then 2020 hit COVID. So he was able to take a lot of that single family that had grew very well in equity, traded that 1031s, did cost segregation studies, into smaller multifamily, and was able to actually become financially free June 2020. So basically been financially free now for about 3 years. So we have a decent sized rental portfolio. We're partners and owners in about 350 units. We have a lending portfolio as well. So that's about $1 million worth of lending. We basically we call it hard money. And I also have some passive investing in multifamily, and it's about 1,000 units in multifamily passive, and then some oil and gas. So that's where I am today. So, and we're constantly looking for deals like everyone else now, and really having a hard time, but we're able to once in a while get a deal. So thanks for having me.
Absolutely, Rich. And thank you for joining us today. And on that note of constantly looking for deals, that also means that constantly thinking of creative ways to add to your portfolio, whether it's directly or indirectly with equity or debt investments and so forth. So given that and our current situation, how would you say your approach changed between back then when you started in real estate and nowadays?
Yeah, when I first started, I was very hungry, so I was willing to go. I would go where the deal was. So I had properties in 5 or 6 counties or surrounding my area. So it was a matter of not being too selective, but just going, taking the deals as they would come to me. Now it's more selective. We're trying to take the low hanging fruit. We are financially free, so it's a matter of protecting your time. Last year we took a lot on. It was pretty frustrating. We also we have our own personal house that we're working on as well, so it was pretty chaotic. But you got to be real careful. In some ways you have to protect that time as well, and sometimes be a little bit greedy with your time, as make sure you're investing it well. So
Got it. Thank you for that. So in terms of your lending business, the clients that you work with, do you ask them to own the property in order for you to lend them on it? Is that correct?
Yes.
Would you say it's the main requirement? And if so, then why is it the main requirement?
So for the lending, I have done a few things. So we've done, land contracts to actual owner occupy. Those at all. We did that for about a year. We did about 4 or 5 of those, which ended up getting those all back within a year because, people were just not prepared, I believe, or what have you. So after that, we basically now we only loan to non-owner occupy. So we're dealing with investors. Generally, it's an LLC that we're lending to. So that's like one of the main requirements. We want to make sure that we want to stay away from those, the rules like Dodd-Frank and things that were created in 2008. So as long as we're lending to, non-owner occupants, that those rules don't apply. So,
Frank, maybe elaborate on the Dodd-Frank rule. I don't know if everyone in the audience knows what it's about.
I don't know. I mean, basically it's, if you do more than like 3 or 4 loans a year, I think you get subjected to these, these rules. And it's basically, in 08, before 08, that there was a lot of, interest only loans or, no doc loans, those things that got a lot of people in trouble. People were buying 3, 4 houses. So they had put rules in place, and that's called the Dodd-Frank, I believe is what they call that. So I don't know the specific rules. It's pretty. I think there's pretty lengthy rules on that. It's just easier for me just to stay away from that, and I have to deal with that.
But you do make sure that it doesn't apply to you, and that's how that happens when you lend to the LLC.
Right. As a non-owner occupant, you don't have those. Yeah. So,
Got it. Perfect. Perfect. What's a typical loan to value, and what is the maximum you lend on as far as loan to value?
yeah, typically we look to try to be no more than 65% LTV. Generally, with the loans that we are doing are smaller loans here in Ohio. So these are rental properties that people buy. So they buy them for. I know I think you're in New Jersey, right, Alina?
Yeah.
So you guys might fall out of your chair, but some of these houses, I bought one this year for like 15,000. The guy's probably put 20-25 in it. He's going to rent that house for about $1,300 a month.
Got it.
These are inner city Akron, Ohio, which Akron has made the news quite a bit. It's as far as buying rentals and making those kind of rents. The numbers are really still pretty good. I think a lot of them now are around 50. Prior to that, you could probably buy a really nice rental up there for about 30 grand. So yeah, that's basically what I'm lending on. This rental that somebody cannot get a loan for initially, it might need, it might need some outside work or inside. So generally the loan or the banks don't want to lend on that until it's actually, fixed and, stabilized. So that's my little niche of who I've been lending to.
Got it. And so it's up to 60 to 65% loan to value. What position do you take? Is it first or second or both?
Yeah. So I only do first position notes. So this is one of the rules that I have. There's guys that do second position. And I think back in when I very first started, my second property was a duplex, and I bought that with a oh my gosh, I can't remember the name of it now. So sorry. Where they take less for the mortgage. What's that called? Short sale. I did a short sale on that property, the second property I bought. There was $99,000 first note, and there was a second note on that property about 17-20,000. So that duplex there was liens against that property for 120,000. The short sale was 56. I bought that property for 56,000. The second position received 0, right? In the first position, they got half, almost a little over half, right? So with that said, I believe, in my opinion, I just don't like to take, I don't want to take chances on that. You're the bank, you make the rules, and if, just like in 08, the banks broke the rules and they got in trouble, right? So you want to make sure you stick to the rules, and if you do that, it's a pretty safe business. I like it.
Got it. Rich, what area do you typically lend in? Is it very close to home, or is there a specific radius around your home that you lend?
Yeah, generally everything is in my backyard, so I have not ventured out. I actually take that back. I did lend to a couple of folks out of my IRA in Arizona this last year. So and that was a learning experience, I'll have to say. So one of those notes was a little. He took the money. It was supposed to be for a month, and it ended up being 3 months. So talking to it started getting a little hairy and little concerning there at the end. I trusted the guy, but it, with it, I kind of learned I should, like I said, I should stay in my lane. That's a lot of learning lessons that I learned last year, and we can go into that, I'm sure, here in a little bit. But you know, generally, I like to lend on stuff that I know the values. I was a realtor for 3 years, so I basically had every good school system in the whole area for 3 years sent to my emails. So I know the values. I know what the neighbors. I know where I can get a pretty good value on that property without even having to really think about that, because I do have that experience. I've invested as well. So, and you don't really have to go that far, because with lending, you don't have, the bad part about lending is you don't have leverage, right? So once you lend that money out, it's gone. You can't leverage that money. So it doesn't take a whole lot of people to lend to get rid of, $1 million sounds like a lot of money, but if you got 10 people you're lending to, that's only 100 grand each, right? So it goes away pretty quickly. So you don't need a huge list of people. It's just a few people that I consistently lend to, and we're almost like partnerships. So
Rich, with that property that was outside of your backyard, you said that instead of 1 month, it ended up being 3 months. But did the client pay you for all 3 months? And what was the lesson learned, essentially?
yeah, that was it was a friend. It was in a mastermind. I was in a mastermind with this person. They were actually buying some multifamily, and that the story was that he needed, it was a $25,000. He needed that just to stay liquid on his deal. He didn't want to take that money out of his account to, so while his loan was in process for the multifamily. So I had lent him that 25,000, and he was going to pay me back 26,500 in a month. So I guess everybody knows that, sometimes these multifamily deals, they take a little longer to close, and there's some hiccups. So
Yep.
The problem is he kind of quit communicating, after about a month and a half, 2 months. It was starting to get little crickets. And that's when I ended up starting to call, I called an attorney down there in that area. I was actually going out for a conference. So I figured, be proactive, and follow up. So I had sent her the note that we had signed. Unfortunately, the note that we signed, I did not file it. It was supposed to be quick and sweet. So then again, there you go. Like I said, I broke my rules, and that's, luckily he did pay me back. He's a good, I had a really good, sometimes you do have to go into your gut, there's,
Sure.
That's a lot too, right? You have to trust but verify, but then again, you just still have to check your gut. So I've been really fortunate in all my years of lending. I've been lending about as long as I've been in real estate. So maybe not on as large a scale, but yeah, sometimes you just have to, have to put there's always a little bit of risk, right? So
Of course.
yeah, it ended up working good. I mean, it worked out, but yeah, I was a little nervous. So as you'll hear later, I don't know if we're going to get into that too much, but I got out of my lane a little bit last year. So it's this year is trying to clean up some of the messes that I made. So
Got it. Okay. So rule number 1, stick to your rules.
yes, 100%. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1, right?
Excellent. Excellent. Yes, that's important as well. So if someone wants to get into hard money lending business, how difficult it is to learn this business?
It's really not that difficult. I mean, if you have purchased properties in the past, you can probably go to your local title company and there's probably a real estate attorney there, and he could probably supply you with any documents you need to do these. I think the only, like I said, you need to make the rules. I think the number one thing would be to get a first mortgage, right? And then make sure that you do this all through a title company, and it gets filed in the counties or wherever you're at. Some areas might not be a mortgage. I think there's other things, but note and mortgage is what we call it here. So you want to make sure you get a good note and mortgage. I have actually escrow instructions. I think I've sent those to you, Lena. You've seen those. So that basically tells them, tells the title company how to close. So there is a little bit to it, but I think once you do one or two of these, and I would say I started doing this through my self-directed IRA, which this lends very well to that because it's short term. There's no asset involved. You're kind of, it's really hands off once the note's created. So yeah, I would work with a local real estate attorney, and I'm sure they can get you anything you needed to get started. And I guess the second thing would be is just to maybe work with your local RIA group. That's kind of where I find my people. I kind of like to deal with the local RIA groups.
Sure.
I don't want to like lend to some stranger. So the other thing I would mention is if you go into a meeting and you say, I have money to lend, you're going to have endless people coming up to you. So maybe what you say is, I occasionally lend money, when we have funds. And like I said previously, you don't need to have any people, 5, 6, maybe 10 people will be enough to create a pretty nice portfolio of lending.
Sure. Rich, we're getting some questions from the audience, so let me read
Sure.
the first one from Eric. Congratulations on your successes, Rich. Do you charge any points on those loans?
Yeah, so here's something I was thinking about, and Alina, you and I talked about it. So generally what I've been doing, I've changed it quite a bit. There for a while I was doing $15 and $1,000 minimum. So or 2 points. But now I'm looking to do like 13%, 4 points. Because the loans are so small, I want to make sure that I get some money up front. So if one of the loans were to go bad, plus I want to make sure I get money, right? So generally these are only like 6-month loans. So you don't make a whole lot of money unless you do charge the points. So yes, I do charge points. And I'm looking right now, what I've been doing is 15 and 2. But I'm looking to do like 13 and 4 or 14 and 3, so I can get a little bit more money up front, to cover if I did ever have to, for say foreclose or go after that person with an attorney. You get money up front. So yeah.
Thank you, Rich. Next question. What are some considerations if you wanted to lend with variable rate HELOC? Would it make sense to lend a prime plus a spread or a fixed rate? Lender appetite for short-term variable rate debt. I'm not sure what the person is asking. If they were to use their HELOC,
Yeah.
probably.
Yeah, I do that. I actually have three separate I don't know, you can kind of call them HELOCs, but they're line of credits through my business. So they're on properties that I have equity in. So I've taken like an equity line on those. So yeah, you can, that's a good way to do it, right? Because that money, the equity is kind of just sitting there. So you might as well, in my opinion, I don't, that's dead money. So why not go ahead and use that? So that's some of the money I do lend is on line of credits.
Rich, when you get a line of credit, that's a business line of credit, right? Because those are not your primary residences; those are your investments.
Right. Yeah.
So that pretty much is at the current like higher rate, right? Like
Right. Yeah,
8.
that's unfortunately, yeah. I could have, there's some, you can lock them in. I mean, that I could have locked those. I just got these 3 lines of credits, probably 3 or 4 months ago, and I could have locked those in at like 7. And now they're around almost 9. So it probably would have been a good idea to lock those in, but I was thinking, oh, hey, the Feds are they're gonna lower the rates. We're gonna get back to those 4s, but it's not looking like that's gonna happen anytime soon. But
They will, just not this year.
yeah,
I don't think
not
so.
this year. So,
Yeah. I don't know. I actually believe they'll raise it at least a quarter point, at least one more time again.
what's a quarter point? We're already at 7.5. So
I know. I think this is a follow-up to that HELOC question. What is the max on the HELOC that can be charged?
sorry, the hot maximum HELOC.
What is the max, I guess, rate on a HELOC that can be charged? And again, I'm not sure what.
Usually they're like 2 points above prime or something like that. I think that's a lot of them, 1 or 2 points above prime. That's what I've seen. But yeah, as far as how high a HELOC can go, I don't know. I'm sure
I
that
think it
the
depends
rates
on the
can go.
bank. Yeah,
It's based on the rates.
for sure. And next question is, what is the maximum loan amount, I guess, for you and your business?
So yeah, the biggest loan I've done so far is 100,000, right? So I have a lot of little loans, a lot of 30s, a lot of $40,000 loans, a few 50s, so yeah, it's but I think you have to still go back to no matter what, even if you're doing say a larger home that's 300,000, you still want to stick to that 60%, right? So just keep to the same rules, and no matter what market you're in or where you're at, you still have to follow that, because say you were actually the larger notes, so if you're at 65%, you have a lot more spread there, a lot more dollar amount at 65. So it's actually might be even a little bit safer to where, if I'm doing $100,000 note at 65,000, there's only 35 grand there. Where if you're doing a 300,000, you could have, potentially 100 grand. So, and then if you would ever have to take it back, generally speaking, if you do it right, you're generally going to make a whole lot of money if you end up getting these properties back. It might be a little bit, I have taken a couple back, and they generally make, I'll probably at least double my money if I end up taking the properties back. So, yeah.
Nice. Next one, can it be fixed rate on a HELOC?
Yes, you can fix rate. Generally, you can do that. Yep. Like I said, I could have locked mine in at like 7.5, but I didn't.
Well,
It depends on the bank too, I'm sure. And then you say HELOC, so there's the HELOC, I think, is a home equity line of credit, right? That's on your personal residence.
right.
Some people may or may not be comfortable with that too. So you have to remember that is your home that you're putting a line and you're lending out. So generally, I'd say that's like 50-50. A lot of people maybe, I would, if you're married and you're with a spouse, I would definitely let them know what you're doing, right? Make sure you're communicating with each other on that they know what's going on too. So
100%.
yeah.
A follow-up question from Jainer. For how long typically, I guess, you can lock the HELOC?
Yeah, that's a good question. I think they're like the commercial ones, I believe, are like 10 years, and then they kind of reset. My small bank that I'm dealing with, if I get to like 100%, so say I have $100,000 line of credit and I pull close to 90, close to 100,000 out of that. Generally he might, after a year or two, he might call me and say, hey, you got this line out. Do you want to, if I buy another property or something, they're like, they might want us to go ahead and do a mortgage, get that out of the line of credit and then go ahead and get it into a mortgage. So, I think they don't, I think they kind of frown on you pulling the 100% of it, at least the guys the bank that I'm dealing with. So, but yeah.
Makes sense. Thank you, Rich. On the earlier topic, so you mentioned that you've used the self-directed money to lend on. So if someone wants to do it, how hard or how easy it is to use self-directed money? Is it as easy as in lending cash, or are there additional steps involved?
So it depends on your self-directed IRA that you're dealing with. A lot of these self-directed companies are pretty used to doing the notes. I use iPlan Group. They're here in Ohio. They're in Westlake, Ohio, and they're super easy. They have the forms online. All I have to do is get a note and mortgage made up. It's not signed. It's just a blank. I send it to them, and with that mortgage origination form, whatever they have, like a note, they say, I guess a note. So you can do, collateralized and non-collateralized, which like I said, I would always do collateralized. You just basically put, and then you can also, you can partner with your self-directed IRA. You can partner with other people in your IRA. You can do your HSA, so there, there's a lot of different, you could do 50-50 or 20-100 or 20-80, like, so an HSA, if you had an HSA account. So yeah, it's really simple. I'm actually mine through iPlan Group. They'll fund the very next day. It's almost too easy. It's like, geez, okay. Well, sometimes they've funded before we're almost even ready. So
wow, that's pretty fast. They
yeah,
fund
they're pretty quick. And their fees, they don't charge any fee. There's just a yearly fee. They don't charge really any other fees unless you do like wire or something like that. So
okay. Well, I think they should pay a commission for this, plug for them.
yeah, so yeah.
Got it.
Well,
Awesome.
when somebody treats you good, and literally, I've done probably, I don't know how many loans to those guys, and it's nice to be able to call them and somebody answers the phone. That is, geez, to get a company nowadays that answers the phone when you call them, that's something. And generally, if somebody answers the phone, they know the answer as well. So to me, that's worth a lot. I hear some,
Yeah,
so
I agree
it's a
with
little
you.
tough.
Yeah,
I get nothing for that. It's just, it's just my experience, and that's all. That's why I would say that. I have
yeah, but
no
I think,
bad words.
yeah, Rich, I think you're right on the money. In the day and age when we can't even call many companies, it's typically the live chat or email when you can call and someone answers and they actually know the answer to a question. That does sound pretty impressive.
Right. Yeah.
So good for you and good for them to have you as a
Yes.
client. Next question from Janer, very interesting question. Can you get a hard money loan on a multifamily commercial?
I guess you would probably call that a bridge note, right? I believe that's kind of like hard. I have not done that, but I believe that's probably more like bridge debt. Alina, maybe you could answer a little bit more to that?
Yeah, so typically if the multifamily requires a very heavy repositioning or going through some sort of construction, they may get a bridge loan that's temporary, that may last anywhere between 12 to 24 months. It's typically done through some sort of private equity group.
or the groups that can lend, because typically multifamilies require a larger amount than just single family homes. But it is certainly possible. As far as the terms, they are also probably somewhat different from the terms that the folks get on single family homes from hard money lenders, for sure. So, Rich, on that note, it sounds like you've been lending for the most part to investors that are buy and hold. They buy reposition homes and then put their tenants in. Would you lend to flippers? Yes, why, or no, why? Can you elaborate on that?
I would lend, I have lent to flippers. So, but I'm still sticking to the same rules, right? 65%, right? And generally when the flippers, I don't do some hard money guys will do, like, they'll allow draws. So you say initially you give them, say it's $100,000. Say you give them 60 to buy, and then they can, as they do the repairs, they come to you for the draws, which that money would be in an escrow account. I don't do that. I do interest only. So I don't even amortize these. They're interest only notes. So and I do collect monthly. Some people don't even collect monthly. They just, they'll just collect the interest at the end of the note. So it's all on what makes you feel comfortable. I like to do the monthly payments just to kind of remind them that hey, you still have my money, and and they feel it a little bit, right? They know that every month they pay me, that they see that money going out. So that's kind of how I've done it. So
Sure. Yeah, as long as it works for you and that makes you feel comfortable and confident to proceed with the process.
A lot of the flippers like to pay the interest at the end. I would say that if you're going to deal with a flipper, generally they're probably going to want to pay the interest at the end, because that's when they sell and they can pay everything off then. So
got it. So that's a big difference between the buy and hold investors versus the flipper.
Yeah, I would say, because they're not cash flowing when they're holding these.
Yeah. Rich, we talked about some pieces of the puzzle, but can you walk us through the lending process overall, how you do it, the timelines, returns, where you start, where you're going, and then where you end up, like the whole process flow, please?
Yeah, so generally someone will reach out to me and ask they'll ask for, their amount of money, and then they'll give me an address. So that's the first step, basically. After that is to basically maybe do a drive-by or look at the property. Just make sure that there's the value there. It's not something that's generally the guys I deal with, they're experienced. So I kind of, I don't have to look too deeply into this, but if you're just getting started, I would definitely probably at least go walk the property with them, maybe take a look at it, just make sure you know where your money's going. So once you agree to that, the next step would be is to get the note and mortgage created, and then also create your escrow instructions, which is the instructions for the closing person at the title company that's going to close it. And that's basically going to tell them not to release your money until you get, a clear title on that property, make sure there's no liens or anything against it, or anything encroach, any of those things. Once they are able to provide you with that title policy, then they're allowed to release that money. So that really your part is just getting maybe the documents presented, or if you're working with an attorney, they'll create all the documents for you. You just kind of have to tell them the terms. So my terms lately has been 15 and 2, 15%, 2 points for 6 months. And then I actually charge another 2 points for an additional 6 months. So that's how I've structured a lot of my notes here recently. So yeah, it's basically 6 months to a year. And then that's, you just, every month you collect a paycheck, right? So it's pretty passive, especially if you're dealing with, good people. It's mailbox money. It's pretty simple.
You certainly make it sound very simple.
Yeah.
Thank you. So on that note, did you have any foreclosures?
No foreclosures. So I did, like I told you, I did some land contract with some owner occupies. That I had done, I believe there's 3 of them. Really, I think it wasn't about 2 years ago I got the last one back. So there was one of them that lasted for about 2 years. So I got all those back. The problem with the one owner occupy is, and which I didn't know, the one guy I sold a house to, land contract, and I didn't realize he was married. And that's very important, right? So his wife, or whatever that was, she was in Las Vegas, and he sends me a note and says, "Hey, I'm moving to Florida. The keys are under the mat." And I'm like, "Oh, that's not good, because I have to get a release, right? Because they have a land contract in the state of Ohio is a legal document." So I immediately texted this guy back, said, "Listen, you need to sign a release, and your wife has to sign off as well." I'm not really sure. I think actually I learned it because she moved in like a little while after he had purchased that, and I had found that out. Luckily, she wanted nothing to do with the house, and him as well. So they literally, like the very day or two later, they signed off on a quick claim deed back to me. So that was a little scary. A couple other notes that I had gotten back, which I can talk about a little bit real quick, is it was an investor. We had been working together for a couple of years. Unfortunately, he had gotten an ugly divorce. He had gotten himself into alcohol and things, I believe. I don't know the whole story. The last note I did, he borrowed on a property that already had a hard money loan against it. So when my hard money paid his hard money loan off, I believe he got like a couple, $2,000 or $3,000 at the closing table, right? So it was basically, he was running out of equity on a lot of his stuff, and obviously had life trouble. So what I had done, he basically quit paying me there for a couple months. I offered him just basically cash for keys, and he took it. I knew he needed money, right? So it was just a matter of, hey, I don't want to go through some foreclosure I'm going to pay $3,000 or $4,000 for and take 6 months. Oh, how about I just give you $1,000 and you walk away? And it worked. He signed a quick claim deed back to me, and I kept that property in my portfolio for about 3 years and rented it to the same tenant he had. And then we sold it for like double what we loaned him to. So we collected rent for 3 years and also made double on the sale. So yeah, as long as I think it's just like, even when you buy a rental property, right? If you buy right, it's always it generally works out. You got a lot of options, right? The same way if you're lending, if you have to take one of these back, just kind of have it in mind. If it's something you don't want to take back, then maybe you shouldn't be lending on it.
Makes sense. Makes sense. And Rich, in your case, there's always no cross collateral. Is that right?
Right. Yeah.
Very important. As you know, and many folks had probably heard, recently in the news, there was some Chapter 11 news about a few crowdfunding platforms. One in particular that I still remember is Peer Street. How do these kind of news affect your industry, and does it also require you to change your lending process in general?
I don't think that affects what I've done. Anyway, I think with the interest rates increasing and the banks tightening, it's actually creating even more opportunity for the lending. You know, because the banks have really tightened their rules up. So um, one of the issues that could be, which I haven't really ran into yet, is, you know, for those people that are lending, maybe they'll have a little bit harder time getting the loan refinanced out. So as far as this crowdfunding and things, yeah, I don't really know a lot about what those groups are, but just remember, you know, Zillow, you know, Open Door, you know, they tried to play this game too, and we know that real estate is local, and you really need to know your market. So if you're going to lend to somebody, you better know what you're lending on. You know, just for like an example there. So you know, they keep saying that the Wall Street guys are going to come in and take over the real estate, and I think they've found out that it's not that simple, right? That like Akron, Ohio, is you can go a block or you can go around a street and the prices change so much, so drastically. Like Cleveland is really, you know, really spotty. So you have to, real estate's all local, right? And I think that's maybe what happened to a lot of these companies like that. They're just trying to invest in a broad area, but you know, you can't always count on that, you know, because like I said, prices can change drastically from one neighborhood to the next.
For sure. For sure. Makes perfect sense. So, Rich, you took us through this scenario where you gave cash for keys and the property ended up sitting in your rental portfolio for a few years and turned out to be a great sale afterwards. Have you had other cases where maybe it wasn't so good, or where you had to either sell it or reposition the property that you took over?
No, not anything other than that. My very first note was actually interesting. There was a local bank here, small local bank, and what they done back then is they would close the notes in house. So they once you got approved to that bank, they would basically give you a signature loan. You go down, they give you, say, 60-70% value. So they would basically just hand you a check and you would basically buy cash. But then within 60 to 90 days, you would turn around and put that turn around and put that into a mortgage. So what this guy had done, I introduced him to this bank, right? He had owed me money and another partner, or not a partner, but someone else that did hard money as well, a friend of mine. Long story short, he paid her and not me, right, back, but he financed the property that I had a mortgage on through that bank. They handed him the check, and instead of him paying myself, he paid the other investor back because she was crying a little louder than me, right? She was the squeaky wheel more than I. So
Crazy.
with look, it was really crazy. And lucky I knew the president of the bank and things then, and so he promised me that there was no worries, he was going to take care of it. So it took a couple months, and I did get my money back. So
Good, good. I'm glad to hear that. So, Rich, as far as taking the deals on, you mentioned that you like them to be local, and one of your primary sources, in addition to title companies and attorneys, are local real estate investing groups. So, say someone walks over to you at the meeting and asks to help them with lending. If this is the first time you're meeting them, would you still lend them? Would your considerations change? Like, what's your process like with someone that is brand new to you?
yeah. So, just like having partners, I think you need to, there's nothing wrong with doing a little Google search. And also if it's somebody you really don't know, you're either A, you need to talk to other people that may know that person, or B, you can do a background check. There's nothing wrong with that. If this person is who they say they are, they should not have an issue with you doing a background check. So, but I would say generally I don't lend to someone that I don't know, like someone off the street. Like I said, there's a handful of people that I lend to, and generally that person might recommend me to somebody else, or one of my other colleagues that do lending, they might say, hey, I don't have the funds, here's someone that I've lent to in the past and they've done well. So yeah, it's not real hard to get into. I think the hard part is just having enough funds to keep up with those people, right? So if you do have a few investors that you lend to, then they count on you, right? You want to make sure that you try to have funds for them whenever they need it.
Makes
So,
sense. Makes
yeah.
sense. Awesome. And our final question, unless I see something else pop up. So, Rich, we're in the people business, right? And as someone who's in the people business, sometimes the human factor comes into life. Do you take the human element into consideration? Are there situations where you're more lenient or less lenient than others because of the human element?
I I think my story about the Arizona person will tell you that you shouldn't probably. I mean, it's business. I think you need to treat everything like business.
Sure.
And you should have just like when you're renting a rental property, you have a list, right? You're going to let rent to somebody, and you treat everybody fairly, right? I think this is the same thing. You want to make sure you're just, yeah, you might have repeat customers, right? But I still think you need to have rules in place and literally have those written down and make sure that you're following those, right? And just the same if you're renting to somebody as a landlord, which I have management company, but they have their own rules, right? Three times the income, the rent for income, no evictions within the last 5-6 years. But same thing with their lending. It's the same thing, 65% LTV, first mortgage, non-owner occupy, the same kind of rules every time to every person. And it's just business, right?
Awesome. Rich, thank you so much. This has been phenomenal. For the folks that want to reach out to you, why don't you tell them your contact info, and I'll place it in the chat for you as well.
Sure. Yeah. So I have a website. It's investwellcap.com. So that's investwellcap.com. And I see she put it in the chat there. So, and then my email is rich@investwellcap.com. And then also there's my cell phone. Feel free to reach out, 330-309-4548.
Awesome. Rich, this has been a great learning experience for us and our investors, and I'm sure some folks will want to reach out. This is also going to our YouTube channel, so some of the folks will be watching it later, probably over the weekend. Again, thank you so much. You're a wealth of knowledge, and we look forward to having you back sometime in the future again. Bye,
Thank
everyone.
you. Bye.